Welcome to the another edition of Agarwal Advisors. Today we are discussing the direct tax proposals which has been presented by our finance minister in Union Budget 2018. Let's discuss few personal tax proposals. The country has lot of expectations from the finance minister in respect of some relief to be provided to individual taxation, especially the salary class. However, it seems nothing much great relief has been provided to the individuals or the salary class. The income tax slabs and income tax rates to remain unchanged for individuals. Further, the education cess and higher education cess replaced by a new cess called health and education cess. Thus, the 3% cess becoming 4% cess. So there's an increase in cess which will result in more tax. So here we are giving you the tax rates for resident individuals, and there is no change as compared to the current year and what is going to be the next year. Up to 2.5 lakhs, there is no tax. Between 2.5 lakhs to 5 lakhs, there is a 5% tax. From 5 lakh to 10 lakh, the tax rate is 20%, and above 30%, above 10 lakh, it is 30%. And yes, there will be a surcharge if your income more than 50 lakh, 10%. If the income is more than what you call 1 crore, the surcharge will be 15%, and on top of that there will be a from the next year there will be a cess of 4% in place of current 3%. There are few other proposals like 40% exemption has been provided on withdrawal of NPS. Any termination compensation paid to employees is not taxable, which was earlier the doubt whether it's a capital receipt or a real receipt, but now they're saying any benefit compensation termination contract, whether it's payable to anyone, is a taxable. And another change which has been provided, they have removed medical expenses 15,000 reimbursement, and also transport allowance which is 1,600 per month. So they have removed that. In place of that, they have introduced 40,000 per annum standard deduction. So due to this change, there is a relief of income up to only 5,800 to any individuals. There are some good news. In the case you are under health insurance, the limit has been increased up to 50,000. And further, in the case you are opting for a senior citizen premium, medical premium, then you can go for another 50,000. So in total, you can claim 1 lakh deduction under 86 and 80D. I have given below example by which you can see how reduction under section 80C 80D can be claimed and which can result up to a deduction of 1 lakh rupees. There are more benefits have been provided in respect of medical expenditure, which is under section 80 DDB, which is in respect of critical illness. Please refer what is meant by critical illness. Then you can any SSC can claim it, and the limit has been moved for senior citizen to 80,000, and for very senior citizen up to 1 lakh. Further, reduction under section 80 TT, which was 10,000 for all right now. For senior citizen, it has been increased to 50,000, and further up to 50,000, no TDS will be deducted on any bank deposits. So this is a good move for senior citizens. You can find out. This point required to be noted that in the case you are claiming any deduction under section chapter 6 say means from under Section 80C or 80D, it is mandatory to file tax return. It has been found that a number of people, especially the salaried class, they don't file their tax return. So they thought that whatever tax has been deducted. So this is not a compulsion on them to file their tax return. Now, what is happening in the case you don't file your tax return before 31st July 2018 for March 18, then your employer has provided you a benefit of 80C or 80D in your estimated tax computation and accordingly deducted less TDS and provided you Form 16. If you don't file your tax return before the mandatory date, then this benefit of Section 80C, 80D is not available and you end up in higher tax liability, which is not going to match with your TDS deducted by employer, and then you become a defaulter. Okay, and you will be land up paying taxes, interest, and penalty. So, for all people who are required claiming any sort of benefit of Chapter 6, say any kind of reduction under Section 80C, 80D, 80E, whatever they are claiming, please file your tax return before 31st July. You have to file it. Further, I am also asking companies, okay, to take a declaration from their employee that they will file their tax return on or before 31st July 2018 or every year. Otherwise, in the case they will become a defaulter, it may happen that tax department or TTS department may invoke provision under section 201, okay, and may trouble the company. So please take note of that. Now we move to our next section, corporate tax. In corporate tax, the tax remains unchanged for other domestic company, but it's a good news that for companies whose turnover is up to 250 crore, they are required to pay tax only 25%. Further, in the case of deemed dividend under section 222E, the concept of dividend distribution tax has been introduced. Okay, and the effective rate of dividend distribution tax in case of deemed dividend is 34.95%. Here we are providing a kind of summary of corporate tax, what is happening. Okay, so companies whose turnover is less than 250 crore, they are going to be benefited, but in the case companies whose turnover is more than 250 crore, they are end up paying more taxes because of increase in cess, which is from 3% to 4%. Similarly, there will be an increase in MAT rate also because the tax rate has been increased from 3% to 4%. This is a very bad news, not for only companies but almost for all individuals also, that long-term capital gain from equities is now taxable. So, in the case you are having a long-term capital gain more than 1 lakh, which was earlier exempted under Section 1038 of the Income Tax Act, now become taxable at the rate of 10%. But here they have come with a grandfathering clause that whatever market value around 31st January 2018 is there. So up to that market value, the government is allowing you the long-term capital gain benefits. But any change in value after 31st January 2018, okay, is not considered for this. given below a chart which will explain you how to compute long-term capital gain. So you can say that whether we have purchased on or before Jan 31st, 2018, and in the case we held less than a year, then it becomes short-term capital gain at the rate of 15%. And in the case it is hold for more than 1 year, then if it is sold after April 31st, okay, then if the value is more than 1 lakh, okay, then same is subject to capital gain. Now, the government also has followed the BEPS guidelines, and accordingly, they have make some strategies for avoidance of artificial PE. But the point here, what I'm like to discuss is that still this has been included in the Income Tax Act. Any benefits or relief provided in the double tax avoidance agreement, okay, is going to be supersede this act. So at present, these amendments have very less relevance. But in the future, if the country will sign multilateral BEPS agreement, then the multilateral BEPS agreement going to supersede our existing DTAs. Okay, and then you can found that this clause will have more practical relevance. Anyway, we what in this so it what it has been covered is that here that in the case there is a non-resident who has an agent in India, and earlier in the case he signed the contract, then only he created a PE. But right now, if he's have a because of that agent, if the foreign entity have a significant economic presence, then they also create a P in India, and accordingly tax record to pay in India and file the tax return, all the compliance will creep up. Another important aspect is that taxability of digital transactions on economic presence. So in the case we found that any company who by virtue of digital transactions have a very significant economic presence in our country, okay, then that also create a PE in India, and they also require to file tax return, and they also require to pay tax on their income in India. Another important changes which is in respect of ICTS. The Delhi High, the government for March 2007 year in March 2017 has introduced ICTS 10 ICTS they have introduced, and this has been introduced under section 145A by way of a CBTT circular. The Delhi High Court has not said that this ICDS cannot be implemented by way of CBTT circular, as this overrides the constitutional power of the parliament. Okay, so any change required to be done should be done through change in the act. So accordingly, the in this finance bill, changes have been made in the section only to incorporate the changes which have been proposed in the ICDS. Further, it is with respect to effect from 1st April 2017. So now it is a very big problem for the companies who has not complied with the ICDS requirements while filing the return for March 17. So for them it is a suggestion to file their vice return. Let's see what other things are there. Charitable trust and other institutions are now also required to file TDS, and in the case they don't do, then they will not get deduction for that with penalty. Further, on this mutual funds on equity also now subject to 10% of dividend additional tax, and as we stated earlier, any compensation received is now subject to income tax. Thank you. In the case you have any query or any concern, please feel free to contact us. You can call us, or also you